So next up we have a panel moderated by Simon Barnby from Archax. I'll let Simon come up and introduce his panel. It's part of the big, why are we here? Are we here saving money or generating revenue? What's the real business case behind what's going on with digital assets? So Simon, I will hand over to you and let you introduce your panel.
Great, thanks very much, Anthony, and good afternoon, everyone. Really pleased to be here. Whilst the panel are coming up to the stage, maybe I'll just introduce myself. So, Simon Barnby, I'm Chief Marketing Officer of Archax, the first and only FCA-regulated digital exchange and brokerage and custodian, so based out of London. Very happy to be in Singapore here this week. Regulation is a key part of what we offer. Getting FCA regulated was a pretty tough process. It took 2 years. In fact, that photo was taken of me before we got regulated, so you can kind of see the effect it's actually had on me. But I'm very pleased to be running this panel today, and the topic of discussion is, digital assets. What are they? Are they a revenue opportunity? Do they provide efficiency gains, or is it something else completely? But let's kick off by maybe a round of introductions. So over to you, Todd.
Thanks, Simon. Todd Stevens, I look after capital markets and corporate development at Inveniam.
Okay, hi, my name is Gerard from OCBC Bank Global Treasury. I look after digital strategy and marketing.
Hello, my name is Swen. I run the digital custody product and also our digital payment solutions for State Street.
Hi everyone, my name is Willie Chang. I'm CEO of HG Exchange. We're part of the Funnel Group, and collectively we consider ourselves the largest alternative assets marketplace in Southeast Asia.
Great, thanks, and welcome all. So, digital assets, are they a revenue opportunity or an efficiency gain, or both, or something else? I mean, maybe if we sort of kick off with just your view from your business, your role perspective, and then we'll sort of drill down into a bit more detail around the subject matter. But so maybe just go across the panel for this first one. So to you again, Todd.
Yeah, so I think like one person's kind of efficiency gain is another person's revenue, and I think most of the people in this audience, the practitioners, we've found ways to make revenue out of these opportunities. So I guess the more orthogonal question is, have our users, how do they interpret and how do they use it? And then my strong view is that from our perspective, when we're doing installations with our accounts, and we have a little bit of a unique approach because we believe that we bring a lot of real world asset users to the blockchain. So we do education and we can get them onboarded in our system, and we can solve some of their current market pain points with valuation as a service or waterfall as a service, and then we think we give them, we say we bring them to the doorstep of tokenization in the digital asset world. So a lot of our people are very, very focused on the efficiency gains, the enablement to their business, how it'll allow them to get more market share ultimately. So first order efficiency, second order revenue.
Great, thanks. And maybe, we'll just go down the line. So
sure. I tend to agree, though I do want to add that I don't actually see them as mutually exclusive. Right, so traditionally, I do admit that most, especially coming from a financial institution, we look at blockchain or digital assets, or for that matter, tokenization, as a purely efficient play. Right, but through that, we actually managed to find revenue models. And truth be told, if we were to continue to invest more monies into this space, there has to be that revenue opportunity, without which it's really very hard to justify the kind of investments that we are looking at.
Yeah, I agree.
You've got the dodgy one, I think. Sorry, Sven.
Yeah, it's blinking, and now it's getting green again. So, obviously, what motivated us in the first place was exactly that new revenue opportunity, given that you have a new type of digital assets in the form of crypto, and it has also proven that it can deliver efficiency, albeit, and you have to acknowledge this, by not being burdened with the regulatory overhead. Now, what for me still is, and I had to change my view, I must say, over the last 12 months or so, that just like taking, if you want, that technology and experience and then plugging it into the traditional finance area and then expecting that same outcome is maybe a bit naive, or maybe it requires a little bit more. So therefore, this mutually exclusive thing, I think there's something to it. So in a way, the question that sometimes is maybe not really asked is what makes then the crypto market efficient, and how can we then have these conditions applicable in our market. And it is more than just I place, a central database with a blockchain technology. That in itself is not good enough. And I think from there is a good then starting point what actually can be done going forward.
Thanks. I actually, hard for me to add to what everyone has said already, but to me, this is actually not mutually exclusive, and the efficiency gains are definitely real. And I mean, we're in the business of digital asset tokenization, right? And so for us, right, the whole reason for our existence is really the revenue opportunities here. So in addition to the efficiency gains, right, the whole reason that we're around is to provide as many investment opportunities, right, and liquidity options for all the different players in our ecosystem. And so the fact that efficiency gains can be seen from this tokenization is something that I think benefits us and everybody that we work with.
Great, thank you. And I think also, I think the technology is also allowing people to innovate, and I think which is interesting. I mean, we're seeing all sorts of interesting use cases. For example, people raising money for their business by tokenizing revenue or tokenizing profit, and so raising money without giving away any equity in the business, but giving away something else instead. So something tangible, but something different. So I think there's probably a multitude of things that the digital assets cover. But maybe thinking about revenue opportunities, opening. I mean, a bit like that example I just gave. Sort of opening up assets that are either illiquid or hard to trade to maybe broader, more global investment audiences. How do you see those kind of things? And maybe back to you, Willie, first on that side of things.
Yeah, so it's been a really exciting ride for us at the exchange. So we do have the exchange license, and basically we found that almost any asset can be securitized. And so we first became famous because we've tokenized what we now believe was the world's first whiskey security. So that's actually live and trading on our platform. So we've gotten a lot of, again, very positive press about that. We're just about to go live with several other luxury goods. But on top of that, right, a lot of the things that we deal with are more traditional securities. And sometimes I have to remind people, right, we're not just doing whiskey and wine, we've got equities, we've got fixed income, we've got funds, we've got real estate. And so the use cases are really, really broad. And we just really want to make sure that we use the license, right, to its fullest and again, provide as many opportunities as we can to the investors who are dealing with us.
Great. No, thank you for that. And Todd, coming to you, I mean, you're obviously heavily involved in the digital asset space, maybe with a focus on real estate originally, but I know that's broadening. What other kind of use cases are you seeing on a revenue opportunity side of things?
Yeah, I mean, I think there's several. So I'll throw a couple out. Like in my previous life, I used to work in securitization a lot on the traditional finance side, and then I remember like you create these, you take all these loans and you throw them in a securitization vehicle and you tranche them up and you sell them out as CLOs, and there's about 100 of these that are issued a year, and you have a choice of buying whatever to the 2022-1 or 2022-40, but they're all very vintage based. And so your risk management ability inside buying a CLO is like you're just buying a micro vintage of that CLO. So in the digital asset world, when all loans will trade digitally, because there's an efficiency play, because no one likes settling a loan T plus 40 days or 30 days or 20 days, they'll settle it T0. And so every loan will trade digitally shortly. Then the proliferation of these loans, you could piece them together and you'll be able to compose them together. And there's firms out here that are doing this that'll allow a practitioner or a user, probably a hedge fund to start with, and then maybe the banks, that they can tailor their own risks in a way. So that's a way that I think that blockchain and digital asset technology will drive kind of like revenue opportunities, because maybe it's a risk management opportunity. But I'll give a separate one. We do a lot in real estate, like you said, Simon. So we're working with a lot of the appraisal firms, like the Houlihan Lokis and the Cushman Wakefields and the JLLs. They're changing their business model tremendously. They used to be an old school analog services firm that gave a valuation once a year and kind of moved on, and they were proud of sending that 150-page PDF out to people, and their job was done. they're changing their business model because of the digital asset space, because these assets are going to require more frequent valuations are needed to trade more frequently. And so they're starting to see themselves as data oracles instead of service providers, and their business model is changing. So they certainly see the revenue opportunity. They need to future-proof the business to get to the revenue opportunity, but there definitely is a revenue opportunity out there, albeit the valuations, prices are coming down, but the volume's going to skyrocket in the amount of items that they will be able to appraise.
Great, thanks. So we've had a view on revenues from the two startup members of the team maybe here, but and we've got Gerard and Swen who are from more traditional businesses, although in the exciting digital parts of those businesses. But how are you seeing anything different? I mean, Gerard, starting with you. I mean, you said it's more about efficiency gains from your side, but do you see the chance for new revenue offices? Is there anything that excites you about the opportunities that could be delivered through digital?
Probably to correctly put it, I see it as we all start out with efficiency gains, but we definitely have to have an eye on the revenue opportunities. From my perspective, if you ask me, I've all along been in the sales line, right? So I'm all about the customer. And to me, it's really about having that customer value proposition, right? What exactly are we trying to add value to our client? So from these digital assets, right, what am I adding value? And that's how I feel that the revenue opportunity will then come. So take for example, if I manage to bring an illiquid asset like whiskey, wine, to my clients that demands for it, that is great revenue opportunity. Or just a very simple product, like say for example, if I am able to make payments a lot more seamless, cross-border payment that is great revenue opportunity. So you see, some of these actually started out as just perhaps on the surface, very efficiency kind of play. But if we do it well and we do it right and we have the customer in mind, it becomes a great revenue opportunity.
Great, thanks. And Sven, what about you? Any exciting, innovative opportunity you've seen in the digital space?
Of course. I mean, that's why here. So I would very much say, I mean, the starting point is it creates an almost like unlimited revenue opportunity. Just you have to keep in mind that obviously it's a cannibalization effect if you have existing asset management business. But nevertheless, I think what fundamentally attracts me to it is this change in terms of where that value is actually captured. So today, if you think about our industry, you have like trading, middle office, back office, and then all the value, the profit is created upstream. But if you truly have a blockchain system, and there's no more, in that sense, a difference between a trading position and settlement position. The enablement of trading, therefore the enablement of profit, now hinges on a blockchain allowing smart contracts, whether that is permissionless, permission makes no difference. And that is really, I think, what we always thought it would be, is sort of this app store of financial services, where suddenly, if you want to come in, you need data, you need text status, you need data oracles. Now, somebody has to orchestrate that, and that allows, if you want, the core infrastructure now to participate in that value creation. So it doesn't really matter, is it like more or less, I mean, there will be winners and losers. That's not so much what my point is, but the way your business model is structured is a very, very different one. It's no longer you have a client, you have some basis points for asset management, you have some, or assets under custody, and you have some settlement fees. In future, it's really, you expose data in digital form, and you make this part of the ingredient for somebody else to cooking up some very interesting business models. And that is, in a way, the future of banking, where we really have to learn from the crypto industry. So therefore, in that sense, the revenue is unlimited. But if you get it wrong, you may end up with nothing. So therefore, for us, it was very, very clear. If you want to be in this business and you want to be a meaningful player, you can no longer have this as a sideshow. You have to really take the assumption, whatever your time horizon is, this is everything. And therefore, you build a business model and infrastructure that anticipates that change. So that's really what I'm thinking about. Is what I can't tell you, is it now next year or in 5 years' time or 10 years' time? Hopefully, it's in my lifetime, but we were working hard on getting there.
Yeah, I mean, I think at Archax, we've seen all sorts of interesting opportunities pass through our books and looked at various interesting projects. I mean, the guys at Bond Value, for example, with the tokenizing bonds, think that's really exciting and interesting. Some of the more unusual ones, maybe, I was talking to someone who's an Australian billionaire who is tokenizing, his groups of racehorses and, allowing people to own a piece of a portfolio of racehorses. When they win, the winnings are distributed by stablecoin directly to your wallet. So, interesting ways of sort of leveraging the technology. I think the most unusual one is tokenized racing horse semen, which I didn't know was a real thing, but apparently it's absolutely huge. Frozen horse semen is a huge thing in the horse racing world, particularly in the Middle East. So there's a project tokenizing that. But moving on to the second half of this subject, efficiency gains, and maybe I'll come straight back to you, Swen, because, as I say, you and Gerard are from the more traditional side of things. Where, and I know you touched on this a little bit already, but where do you see the most sort of obvious efficiency gains from tokenization, blockchain, digital assets? Or maybe some are being realized, or maybe some are yet to come. But how do you see that panning out, Swen?
Well, maybe from experience, right? So we announced, Irfan mentioned this earlier in March, a cooperation with Copper to use their software as a, if you want, a buildings block for our digital custody solution. And we have been running that for quite some time. And if you're looking at this, sometimes quite shocking, I can run a custodian without operations, really. So in that sense, these benefits are clear. What then makes it very hard is like, how do you introduce this into a traditional finance organization where there's the expectation there's a responsible party? And that is something that almost is like counterintuitive, because digital means you trust in code, the data is digitally verifiable. And it's no longer a question, is it a regulated entity is doing this or not? You have to move beyond that. And that at the moment in the current regulatory paradigm is, difficult, if not impossible. So that's what I'm saying is like technically speaking, you can automate everything. Practically speaking, we're running to all of the old issues that we discussed as the security industry for 30 years. What's the liability? I can build a tax or like a KYC utility. We've built so many of those. But the question is, if you are doing a KYC, do I trust the data? Of course not, and vice versa. And so therefore, unless we find a way to getting over that, this is all smoke and mirrors. And I think for me, this is something that, unfortunately, the fintech industry doesn't really appreciate how severe the problem is. And maybe we, as the traditional finance industry, we don't appreciate how easy it is to solve it from a technology perspective. And something in the middle, hopefully, we find a way to bring it together, and that is the only way forward.
And Gerard, back to you. I mean, you've said already that efficiency gains are probably your focus for you and your organisation. And where are those most prevalent? Where's the most obvious efficiency being realised?
Okay. Generally speaking, I think where most of the financial institutions, at least in this part of the world, we are looking at primarily will be in the space of, say, trade finance. Right, we're looking at digitalizing LCs on blockchains. We look at settlement. We look at real-time settlements, and probably even on the payment space. Right, of course, for the payments. I can always share that just this year, May itself, OCBC, we actually issued our first digital CP as a partnership with MarketNode, leveraging on their blockchain. I think that actually helped to cut settlement time from the typical 5 days to what I believe is now 2 days. Right. Actually, if you think about it, even like we spoke about tokenized bonds, right? I mean, if you just think about it, I mean, the concept of a tokenized bond seems to imply a great revenue opportunity, but underpinning the tokenized bond platform itself, actually there's a tremendous amount of efficiency gain per se. We talk about the settlement of the bond, the creation of the term sheets, the valuation, the marketing, etc. Those are huge amount of man hours that would be actually saved if we were to do so. And that's where I think actually, if you ask me, the line now, therefore, between whether it's a pure efficiency play or is it a revenue opportunity is grey.
Yeah.
Can I just say one thing on the bond tokenization, because that for me is a very good use case. So we have a number of had actually for some time institutional investors investing in these digital bonds. But again, it's the same problem. So the issuer says, I have my own KYC obligation. I cannot distribute them peer-to-peer. So I just still sell them to an investment bank. And that investment bank is then subject to the same KYC obligation. So yes, you have the peer-to-peer technology, but the business exchange is still very much central. And therefore, you're then now introducing this, but you end up in the same place as before. So therefore, this was one of the conditions I mentioned earlier. What is the driver of benefit of blockchain? It's digital data, it's peer-to-peer. What is the market segment that allows you to do that? And at the moment, it's very much an unregulated market space, so therefore it can really work. But sort of a regulated asset manager buying a digital bond, we have these examples. I just don't think it creates right now an enormous efficiency benefit, quite the opposite.
Yeah, no, I understand. I think you've both touched on it a bit, but I think if you kind of look at settlement, look at the post-trade process in equity markets, for example, so, I mean, they're hugely inefficient, so many intermediaries, there's a huge opportunity. It'll take regulations to change or evolve, which they will do, but, to disintermediate that market and really improve efficiency, faster settlement times, and less reconciliations going on is a much better world. But Todd, I think you were...
Yeah, I mean, just to hit on that, Simon, I mean, it's a great point, because I think one of the cooler things that's happening is the interplay between kind of blockchain, instantaneous settlement, and payments. I mean, and just take, for example, I mean, you're a 24-year-old kid, you have your first job, you get your paycheck automatically goes into an investment, it goes into an ETF, S&P 500, Vanguard, whatever it is. But it's always at work. And then you just take your money and you buy an ice cream, you buy whatever, a food, dinner, and then it debits out of your digital Vanguard account, S&P 500, and pays payments. So your money is always at work for you. In the old world, that doesn't work because it took T+2 to settle many of these securities. So these digital securities with instantaneous settlement, mixing that with payment rails, very powerful to allow, like, again, access to kind of like having your money always at work. I mean, if you're a $100 million guy, I mean, you have a private banker that does that for you. But that 23-year-old kid doesn't have that. And I think this unlocks that for him.
Great. No, thanks. That's an interesting point too. Obviously, for digital assets to succeed, then institutional adoption has to take place. I mean, there is a wall of institutional money yet to get involved in digital, and it's beginning to happen, and it'll happen more and more. But what is kind of what are the hurdles that institutions have to get over? As you kind of see things, what will drive institutional adoption? What will help it? What might hinder it? Any view on that? Maybe we'll kick off with you, Willie.
Yeah, I think institutions are really critical to us at HG Exchange, and the way that we're structured is actually around member brokers, right? So big players like Phillips Capital, Prime Partners, Kyle are all playing in our space. And really, I think what it is just building as many use cases as you can, finding attractive products, right? So the whiskey I talked about, equity products, real estate, all of these things that we're putting onto the platform are products that we discuss and strategize with our different member firms. And ultimately, right, anything that finally gets passed through the filter is something that collectively we're all very confident that the end investors are going to be interested in buying and selling.
I mean, I think, providing context for institutions around digital assets is obviously key as well. But Todd, what, from your side, any other thoughts on institutional adoption and what might help or hinder it?
Yeah, I mean, I think all of us in the room, every day we make the mousetrap a little better. So the infrastructure is always getting better, and that's what we're paid to do. And then regulation is getting a little more known, and I think it's improving and iterating along the way. And then the baton really gets passed to education. We have to educate people and continue to re-educate people, and with that, we'll finally hit some kind of a tipping point, and then we'll all play in this digital asset world that we keep talking about. But I think education is going to be critical. But again, infrastructure, regulation, education.
Yeah, I'm glad you used the R word, because we haven't really talked about regulation. But again, maybe to you, Sven, I mean, how do you see regulation side of things helping and hindering? What are the hurdles we need to overcome for institutions to be able to move in?
Yeah, for me, this is not a function of having a solution that's either cheaper or it's better. It doesn't have to be either of those things. It has to be different. And different in a sense, and you look at any innovation, it's always the same thing. There's something to it that suddenly changes what you perceive valuable and how you make a purchase decision. And that at the moment is sort of a bit of unexplained, because people looking in those dimensions show me that you make a cheaper, or show me that somehow it's all it creates new revenues. And then maybe it can't do either of those things. Now, there's a couple of things. If you think about today, there's a number of crypto asset managers or digital asset managers, and the client base they have were never really used to the traditional way of integrating investing. They have no clue what the Swift message is and how it should possibly be integrated in the middle office. They have no desire to come back. So if you want that market is only going to grow. And there are a number of ways how these organizations have structured their business that for me is good enough to say they have a different user experience, and that in itself will grow over time. So I think that we have to accept that in a way, I liked your example very much earlier, sort of, I think the way we learn banking probably is not how younger people are doing it, and we shouldn't discount that experience, and that over time will make it happen. But ultimately, and I think that's very important, is there needs to be a recognition that in a way, if you want to have a truly sort of peer-to-peer model, you need to, from a regulatory perspective, allow basically to introduce the concept. That for me is the fundamental thing, that market governance and control can be solved through economic incentives as opposed to command and control. If that idea doesn't find at least a little bit of acceptance, then quite frankly, I'm not sure we will really get the full blown efficiency in the traditional financial market in the same way that the crypto market was able to do that.
Yeah, I mean, I think, in our conversations with institutions, one of the problems is regulatory clarity. They just want clear regulations. So they know at the minute, some regulators are clearer than others, and that regulatory clarity is important. But also the global regulatory matrix is complicated, because I think Graham, in his fireside chat earlier, touched on the point that pretty much the regulation around crypto is pretty much the opposite in Singapore to what it is in the UK. So, so it's a complicated sort of landscape to navigate as well. But Gerard, back to you on the regulation side. I mean, any thoughts from you on the hurdles, the pitfalls, what needs to happen?
Well, I generally agree with the panel. I guess I can say that I'm thankful to be part of this, in this country where our regulator is rather clear, right? I mean, they clearly say what you can do and what you cannot do, or what they don't want you to do, right? In fact, over here, I mean, they actually kind of spearhead some of the projects. I think we heard about Project Guardian earlier this morning, which is good. I do agree, though, that the whole concept of regulation probably has to go hand in hand with education. I think one of probably some of the feedback that we have probably heard is that, in this period of crypto winter, originally we may find people who are very keen to invest, suddenly because of the concept of crypto winter, and then they start not to invest anymore. They are scared, right? So some form of education has to go with this regulation in order to make this work. Yeah, no, the E word is the other key one, isn't it? So,
can I just one thing on this? This is actually also the other thing. If you think about it, it's not just like clarity. Then sometimes you may get the wrong kind of clarity. I wouldn't discount that problem either. Take the US right now, right? So the SEC has issued these accounting rules, which says the technology challenges of crypto are such, and crypto meaning both tokenized financial instruments as well as crypto, that any asset you hold is a liability, and you have to put it at market value as a liability on your balance sheet. Whilst in Europe now with MiCA, they're saying if you run a blockchain-driven settlement system, then as a provider, you now take a liability of these assets that is the strict liability under FMD. So you have like two big regulators who are like coming to almost like opposite conclusions, but both saying the root cause is this is new and therefore risky technology. I'm like, how are you can you explain that? And something has to give at the moment. So I think there's I don't think it's good enough to say, let's get more regulatory clarity. You may get the wrong answer at the moment that you probably don't want.
That's a good point. It's a good point. Well, we have a couple of minutes left, so I'll just see whether there are any questions from the audience. Anyone got a question for the panel? Yes. I think there's someone running with a microphone, so let's just wait for that.
Is it working? Yeah. I just have one question. I mean, to participate in the digital asset world, you kind of need to invest in it, right? So I kind of like to hear some views on return on investments.
Who'd like to take that?
I didn't hear the question. Could you say it again?
Yeah. To participate in this digital asset economy, we will need to invest in it, right? There's definitely investment you need to put. So I'd like to hear some views on return on investments. Right, what's your view? Like, are we going to get return on investment in like a year, 5 years? You know, what's that view? You kind of, before you invest, you kind of want to get something out of it, right, eventually?
So you're asking what the return, how long it's going to take to
What's the view,
yeah.
right?
So we talk about this revenue generating, you know, how long is it going to take? I think you've mentioned this in our briefing call, Gerard, too. Yeah, what's the time frame for digital assets to be sort of, you know, for people to get a return on them?
Well, if I just quote statistics, right? I think there's a publication that says that in 5 years' time, tokenized assets is worth about $7 trillion US. So it's obviously not small. But I think the issue then is for most of us, I believe, is really how can we quantify the kind of investment returns, not in 5 years' time, but probably in the next 1 to 2 years, right? Because we all grew up in an environment where we expect to see instantaneous returns. I think that's the challenge. I have no ready answer to you for that. Well, I also want an answer, actually.
I think from my point of view, I mean, we are a liquid exchange, and so you could be trading on our platform anytime, 24/7, and that means that if there's some good news or some press release, right, about any company that's listed or any asset that we have, right, potentially even within the day, right, you could be making some gains or some losses, right? Let's say that tomorrow there's a report that says whiskey causes cancer. Right, this could end up being, a really traumatic event if you're holding onto this token. And actually, from the exchange point of view, we don't really want to take a position on the price, but hopefully, right, everybody will be a winner, and eventually, long term, whatever it is that we have listed on the exchange is something that our end clients will be making money on.
Thanks. Yeah, I think there was one more question here. The lady here had a question too.
Hi there, Vic Wells from Old Law. One of the things that I've heard discussed today is duplication, replication, inefficiencies, multiple AML CTF activities on multiple sides of transactions. And we have smart minds in the room, we have great technology. I wanted to hear from you around what it looks like to actually have regulators perhaps collaborate, what it looks like to solve some of these inefficiencies, particularly for VASPs that seem to have to go around the world and collect licenses like their Pokemon cards. Is there a better solution?
I think we've been in a bear market for regulatory kind of a collaboration since the great financial crisis. And regulators aren't compelled to reach across to their brethren in other countries. I mean, it's the balkanization of regulation, and I don't see that changing. I mean, they have to look after themselves, and it sure would be nice if they extended an arm and they collaborated and said, how could we make this a better global, efficient market? But I wouldn't hold my breath.
Sven, were you going to say something as well on that?
I think that's actually the most important question. So thank you very much for raising this. I'm not too gloomy about this. I just wanna say I'm also very realistic because we have been as a highly regulated GCFE bank in this game for a couple of years, and sort of you build up your expertise. Now, what's not very much what we see is regulators actually saying we need collaboration, so they're now doing cross-regional panels and sharing that. But the other thing is also very important is because we've had investors, leveraging State Street to invest in all kinds of digital assets for several years. You start also showing the benefit because I think, in a way, what a regulator easily can do is they can prevent anyone, stopping them from investing, but they cannot force an investor to invest in a traditional way once they've experienced the other thing. So it's no longer, it's just like a single voice. It's actually showing this market will operate very, very differently, and also the regulation has then to look at this very, very differently. But this is a benefit for the from an investor perspective. We've had a number of jurisdictions that actually brought up that issue, which is very important. We have, particularly in the Western markets, a pension problem. If you can't find that alpha, you're creating a problem. So I think the discussion is broader than just there's a bit of tech and we save some operations people. It has to be about this question of a digital economy overall is happening, whether we like it or not. So you better get ready. And I think I sense a little bit of this, but this is something that unfortunately
you can't discuss at a regulatory level, you have to discuss at a policy and therefore government level. And these discussions are happening as well. So I wouldn't say it's 10 years away, it's actually already in the past, but I think the acceleration or the growth rate is much slower than I would have hoped for.
Great, thanks. Well, I think we're out of time now, according to this timer in front of me. So the question posed by the title of this panel, efficiency gain or revenue opportunity, I think the answer is both and more. But thank you very much, everyone, for listening, and thanks to my panel for participating.